Welcome back to the BMAM podcast. Today we're looking at finance and accounts, section 3.1 Sources of Finance. What is finance? It refers to the funds required for business activities needed for example, a startup cost, day to day operations, business expansion.
Internal sources of finance. This includes retained profits, uh, the profits that are reinvested into the business, and the advantage is there is no interest or repayment. The sale of assets is selling unused or unnecessary assets, such as old computers or old desks. Desks. Personal funds, owners' personal savings. It is very common in startups. External sources of finance, we have loan capital, which is a loan from a bank and so on or other lenders. We have share capital, funds raised by selling shares to investors, such as yeah, grants, financial aid from government or organizations, and then leasing, such as uh, a long or short, uh, let's say, borrowing of a product that you pay a monthly payment on.
We have short-term finance, which is less than 1 year. Examples are overdrafts, which are temporary bank account extensions, trade credit, which is buying goods on credit and paying later, debt factoring, which is selling invoices to a third party for immediate cash.
Medium term finance. The time frame of medium term finance is 1 to 5 years. The examples are leasing, so, well, as I said before, renting equipment or assets, and medium term loans are bank loans repaid over a few years. And then long term finance, time frame is more than 5 years, and the examples are mortgages, which are long term loans for purchasing a home or property. Share capital, we have the funds from issuing shares, and then debentures are long-term bonds issued by a company.
Factors influencing finance choices. Purpose of the funds, e.g., a short-term or long-term needs. Cost of finance, for example, interest rates or fees. Size and status of business, and the flexibility and repayment terms. The importance of finance management is to ensure sufficient cash flow for operations, supports business growth and expansion, minimizes risk of insolvency or financial strain, and helps achieve long-term strategic goals. Now we're moving on to section 3.2, which is cost and revenues. What are cost and revenues? Costs are expenses incurred by a business to produce goods/services. Revenues are incomes generated from selling goods or services. Types of costs, we have fixed costs that don't change with output, for example, rent or salaries. Variable costs, which change with output, for example, raw materials or utilities. And then we have semi-variable costs, which is a combination of fixed and variable costs, for example, phone bills.
And then here we have a formula of total costs, which is fixed cost plus variable costs. It is very important for calculating profitability and pricing strategies. Types of revenues. Let's start with sales revenue. Is the It is the income from selling goods or services. Then we have non-sales revenue, which are income from other sources such as interest, dividends, or rental income. Revenue streams is the different ways a business generates income. For example, product sales, subscription fees, advertising revenue, or licensing and franchising. Here is the formula for contribution per unit, which is selling price minus variable cost per unit. It is used to calculate break-even and profit margins.
Then we have the break-even analysis, which determines the level of sales needed to cover all costs. The formula for break-even output is fixed cost divided by the contribution per unit, and it helps assess profitability and pricing strategies. The importance of monitoring costs and revenues is that it ensures profitability and financial stability. It identifies cost-cutting opportunities. It helps set realistic sales targets and pricing strategies. It supports financial planning and decision making. Now we're moving on to section 3.3, break-even analysis. What is break-even analysis? It's a financial tool to determine when a business covers all costs. The break-even point is the level of sales where total revenue equals total costs. It helps assess profitability and pricing strategies.
Key concepts in break-even analysis. Um, the first and foremost, we have fixed costs, which are costs that do not change with production, for example, rent. We have variable costs, costs that change with output, for example, raw materials. Then we have total costs. We have sum of fixed and variable costs, and then we have contribution per unit is how much you pay for the product uh, per unit. Yeah. Break even formula. Here's a formula. Fixed cost divided by contribution per unit. And then contribution per unit equals selling price minus variable cost per unit as we said so beforehand. And then here we have an example. Fixed cost of $10,000, selling price $50, variable cost $30. And then the break-even output would be $10,000 divided by $50 minus $30, which would equal to 500 units, which is the break-even number of units. Here we have the break-even chart. It is the visual representation of costs and revenues. The components are fixed costs, which is the horizontal line, and then total costs that it starts from fixed costs and rises up. Total revenues, it starts at origin and rises with sales. So it starts at 0 on the X and Y axis. And then the break-even point is the intersection of total revenue and total costs.
So we have the margin of safety. The definition is the difference between actual sales and the break-even sales. The formula of the margin of safety is actual sales minus break-even sales. It indicates the cushion before losses occur. Benefits of the break-even analysis is that it identifies the minimum sales needed to avoid losses. It assists in setting realistic sale targets. It supports pricing and cost control decisions, and it helps evaluate the feasibility of business projects. The limitations of the break-even analysis is that it assumes all units are sold at the same price, that it ignores changes in variable cost or fixed cost over time. It assumes constant production efficiency and does not account for external factors, for example, market demand. The applications of the break-even analysis is that it's used by startups to assess viability of business ideas. It helps businesses forecast profit levels. It assists in financial planning and budgeting. It evaluates the impact of cost or price changes on profitability.
And then moving on to section 3.4, final accounts. What are final accounts? Final accounts are financial statements that summarize the financial performance of a business. It includes profit and loss account, income statement, balance sheet, and it provides stakeholders with insights into the financial health of the company. Profit and loss account shows revenues, costs, and profits over a specific period. The structure is we have revenue, which is income from sales, cost of goods sold, direct costs of production, gross profit, which is revenue minus cost of goods sold, operating expenses, uh, overheads and indirect costs, and net profit. The balance sheet is a snapshot of a company's financial position at a specific time. The key components of a balance sheet are assets, the resources owned by the business, liabilities, the debts and obligations owed, equity, owner's investment in the business, and the formula for assets is liabilities plus equity. Components of assets. We have current and fixed assets. The current assets is a short-term resources, for example, cash, inventory, and receivable accounts. Then fixed costs, we have long-term resources such as property, equipment, and vehicles. And then components of liabilities. We have current liabilities and long-term liabilities. For current liabilities, we have short-term debts such as accounts payable and overdrafts. And for long-term liabilities, we have debts payable after more than a year, for example, mortgages and bonds.
So the purpose of final accounts is that it assists in financial decision making. It provides transparency and accountability to stakeholders. It helps evaluate profitability, liquidity, and financial stability, and it's required for legal and tax compliance. Stakeholders and final accounts. So internal stakeholders, managers use accounts for decision making and planning. Employees assess job security and profitability. External stakeholders, for example, investors evaluate returns on investment. Creditors assess ability to repay debts, and government ensure compliance with regulations. Limitations of the final account is that it does not account for qualitative factors. For example, employee morale provides historical data, not future predictions, may not reflect current market value of assets, and can be subject to manipulation or errors.
And now moving on to section 3.5, profitability and liquidity ratio analysis. What is ratio analysis? It is a tool to assess a business's financial performance, such as profitability ratios, which measure the ability to generate profits, and liquidity ratios measure the ability to meet short-term obligations. Gross profit margin. The formula for gross profit margin is gross profit divided by revenue times 100. It indicates the percentage of revenue retained as a gross profit. Higher gross profit margin indicates better control over production costs. The net profit margin formula is net profit divided by revenue times 100. It indicates the percentage of revenue retained as a net profit. It reflects efficiency in managing overall costs and expenses. Return on capital employed. The formula for return on capital employed is net profit before interest and tax divided by capital employed times 100. It measures profitability relative to the capital invested. Higher return on the capital employed indicates better use of capital resources. Current ratio formula is current assets divided by current liabilities. It measures ability to meet short-term obligations and so on. Ideal range is 1.5 to 2. It varies by the industry.
So we also have the asset taste ratio, which is also known as the quick ratio. The formula is current assets minus inventory divided by the current liabilities. It's more stringent of measure of liquidity, and the ideal range is 1 or higher. The importance of a ratio analysis is that it helps stakeholders evaluate financial health, identifies strengths and weaknesses in financial performance. It aids in decision making for investors, managers, and creditors, and is useful for benchmarking against competitors. The limitations of ratio analysis: it relies on historical data, it may not reflect future performance, it ignores qualitative factors, for example, employee morale, and the ratios can vary widely across industries, susceptible to manipulation through accounting practices.
Now moving on to section 3.6, efficiency ratio analysis. What are efficiency ratios? Efficiency ratios measure how well a business uses its resources. They focus on inventory management, credit control, asset utilization. It helps assess operational efficiency and profitability. Inventory turnover ratio. The formula is cost of goods sold divided by average inventory. It indicates how quickly inventory is sold and replaced. Higher turnover means efficient inventory management. Low turnover means risk of obsolescence or overstocking. Debtor days ratio. The formula is accounts receivable divided by revenue times the amount of days in a year, 365. It measures it measures the average time taken to collect debts. Shorter debtor days indicate better credit control. Longer debtor days increase the risk of bad debts. Asset turnover ratio. The formula is revenue divided by total assets. It indicates how efficiently a business uses its assets to generate revenue. Higher ratios reflect better assets utilization. Low ratios suggest underutilization or inefficiencies. Importance of efficiency ratios. It helps to identify areas of inefficiency in operations. It provides insight into inventory and credit management. It also supports financial planning and decision making, but also benchmarks performance against competitors. Limitations of efficiency ratios. It relies on accurate and consistent data, does not account for qualitative factors such as supplier relationships, may vary significantly across industries, and it ignores external factors such as market conditions.
So we're moving on to section 3.7, which is cash flow. What is the cash flow? It refers to the movement of cash into and out of a business. Categories are cash inflows, which is money received by the business, and cash outflows, which is money spent by the business. It's a key indicator of liquidity and financial health. Importance of cash flow is that it ensures the business can meet short-term obligation. It helps avoid insolvency and bankruptcy. It facilitates smooth operations and planning. It supports decision making for investments and expansions. What is a cash flow forecast? It's a financial document that predicts future cash inflows and outflows. The components are opening balance, which is the cash at the start of the period, the net cash inflow, which is the inflows minus the outflows, and the closing balance, which is the cash at the end of the period. The benefits of a cash flow forecasting is that it helps identify potential liquidity problems. It supports financial planning and budgeting. It assists in securing loans or investments, and it enables proactive decision making to avoid cash shortages.
Causes of cash flow problems. Poor credit control, such as delayed payments from customers. High overhead costs, such as rent and salaries. Overinvestment in fixed assets. Seasonal variation in demand. Unexpected expenses or economic downturns, such as pandemics, for example. Strategies to improve cash flow. To speed up the cash inflows, offer discounts for early payments, improve debt collection processes. To reduce outflows, negotiate better payment terms with suppliers, cut unnecessary expenses, and to arrange external financing, overdrafts, or short term loans. Limitations of cash flow forecasting. It relies on accurate assumptions which may not reflect reality, cannot predict unexpected changes such as economic shocks. It's very time consuming to prepare and update, and it does not consider non-cash items like depreciation. And then moving on to section 3.8, investment appraisal.
What is investment appraisal? It's techniques to evaluate the financial viability of an investment. It's used to assess potential returns and risks, and it helps businesses make informed decisions on capital investments. We have the payback period, which by definition is the time taken to recover the initial investment cost. The formula for the payback period is initial investment divided by the annual cash flow. The advantages is it's simple to calculate. It focuses on liquidity. The average rate of return definition is measures the average annual profit as a percentage of the investment. The formula is average annual profit over initial investment times 100. Advantages are it considers profitability and it's easy to compare with other investments. The net present value by definition is calculates the present value of future cash flows minus the initial inflows. The formula is the sum of cash flow divided by 1 plus r to the power of t minus initial investment, where r is discount rate and t is time period. The advantage is it considers time value of money. The internal rate of return, the definition is the discount rate at which NPV equals 0. The advantage is it considers time value of money. It's even compared with cost of capital. The disadvantages is it's complex to compute and it assumes constant reinvestment rate. Qualitative factors in investment appraisal. Non-financial considerations include impact on brand image, employee and customer satisfaction, and environmental and ethical concerns, as well as alignment with long-term strategic goals. The importance of investment appraisal is that it helps businesses evaluate the risk and rewards of investments, supports informed decision making, ensures optimal allocation of financial resources, and it improves chances of long-term profitability and growth. Limitations of investment appraisal is that it relies on accurate cash flows for forecasts, cannot predict external market changes, ignores qualitative factors in some methods, is time consuming and complex calculations.
And then moving on to section 3.9, budgets. What are budgets? They are financial plans that estimate revenues and expenses for a specific period. It helps businesses allocate resources effectively, and it's a key tool for financial planning and control. Importance of budgets. It provides a roadmap for financial goals, ensures effective resource allocations, it helps to monitor and control spending, and it supports decision making and strategic planning. Types of budgets. We have sales budget, which projects expected sales revenue, production budget, which estimates costs of production, such as materials and wages of labor, cash flow budget, forecasts cash inflows and outflows, and then the marketing budget, which allocates funds for promotional activities. Variance analysis. It compares actual performance with budget figures, and then the types of variances are favorable variance, which is actual results better than budgeted, and then adverse variance, which is actual results worse than budgeted. It helps to identify areas for improvement.
So, the benefits of budgets: it provides financial discipline and accountability, it encourages goal setting and performance measurement, it facilitates coordination across departments, it prepares businesses for unexpected challenges. The limitation of budgets is it relies on accurate forecasts, which may be unrealistic. It's time consuming to prepare and update. It may create rigid constraints, limiting flexibility, can lead to short term focus instead of long term goals. Zero based budgeting starts from a zero base and requires justification for all expenses. It ensures every dollar is allocated efficiently. Advantages is it eliminates unnecessary spending. It encourages thorough evaluation of cost. The disadvantage is that it's very time consuming and complex to implement. Incremental budgeting is where you adjust the previous budget by adding or subtracting a percentage. Simple and quick to prepare. The advantage is it saves time, easy to implement. The disadvantage is it may perpetuate inefficiencies from previous budgets. That was all for this episode of the podcast. See you.
Yes. Bye bye.